So this video is going to have a focus on more influences on financial management, and in particular today, we are going to be looking at financial institutions. As you can see, there is a whole list of different financial institutions that the syllabus requires us to know, and these are all listed here. But what is really important is that what you are required to know is not only just the definition of the financial institution, you need to know about financial management and how financial institutions might actually affect the financial management of the business. So yes, it's important for you to know the definitions, but as you'll see throughout these slides, we're also looking at what is the financial institution, but what is the effect of the financial institution on financial management. Remember, this is under the influences section of the syllabus, so we have to look at how it influences the business. So first of all, we're going to start off with banks. What are banks? Very commonly, we can think of Commonwealth Bank, Westpac, NAB, ANZ. They're the big four banks in Australia. Generally, what they do is they take deposits from the public and then they provide funds as loans. So they take those deposits and then loan them out to people and businesses as well. And usually you get small to medium businesses that tend to bank with your sort of standard consumer banks. The financial products that they have is online banking, they have credit cards, they look at overdrafts, which you should remember from our sources of debt. They have services such as FPOS and BPay. So for example, if a business was to have an FPOS machine where they could take card transactions, that would be organized by their bank. They provide legal and tax advice, insurance, economic outlooks, a whole range of different things. In general, though, it's all about accepting deposits and loaning money. So what's the main impact that they have on financial management? Well, really, it's just this whole issue of interest rates. Because businesses are usually taking money out from businesses and they're loaning it out, then they tend to care whether we have a high interest rate or they tend to care whether they have a low interest rate. A high interest rate will mean that they'll have higher repayments and they're less likely to take out a loan because it's too expensive, whereas a low interest rate will do the opposite. We can also look at interest rates in terms of savings rates as well. So they will browse around, and depending on what their interest rate is for savings, if it's too low, they might decide to invest their money somewhere else, maybe put it into shares because they can get a higher return. But savings rates are also important. Now, when we're looking at investment banks, these are banks that don't deal with consumers. So you and I can't go to these investment banks, but they usually deal with medium to large businesses and governments sometimes. So our government right now is taking out lots of loans in order to pay for these economic stimulus packages surrounding COVID-19. So they might actually go to some of these investment banks in order to attain those funds. What investment banks usually do, though, is a step ahead of what normal banks do. They're all about investing money and how businesses can invest. So they tend to provide advice for businesses. They can help them in terms of selling their shares. They can help them in terms of merging and acquiring other businesses or taking over other businesses as well. Or they can actually give businesses loans, but they tend to customize it to specific needs of the businesses. It's a more personal sort of relationship that these businesses will have with these banks, not sort of your stock standard thing that you'll see in normal consumer banks. So they can really tailor to the specific needs of the business. Investment banks impact financial management in three different ways. Firstly, they provide loans that are customized, as I previously just said. So that's very beneficial for financial managers. A business that understands, a bank that understands their needs is highly beneficial to them, because if they are in a period where they're struggling, then this relationship that they have can help them in that way. They can also invest their business's funds in other areas. So if a business has excess surplus cash and wants to invest it in some way, they can help them to do this. And they also provide advice on mergers and acquisitions and really anything to do with financial management of a business. Then we look at finance company. Now, finance company are non-bank financial institutions. So the first two are banking institutions. These are non-banking. And really, they just provide types of loans to consumers and businesses. And these can be secured or unsecured loans. So they're either secured by an asset or not. But in general, these companies tend to charge higher rates of interest than at banks. But having said that, they're usually more flexible and more likely to loan out more money than banks. So banks are a bit more stricter, but because finance companies are more likely to loan you out the money, that risk associated with it comes into a higher rate of interest. And some examples of that are Nimble, Rams, home loans. They do mortgage loans. You might have seen Wizard, a whole range of different companies. And how do they impact on the financial management of a business? Well, they offer loan rates and products for businesses if they require funds. They can also give things such as commercial bills, debentures, and leasing finance, which we looked at in the earlier section of the syllabus. And some finance companies also do factoring for businesses. So that's all about collecting their incomplete debts for businesses. Superannuation fund. So superannuation was introduced in 1992 in Australia, and essentially it applies to all employees between 18 and 69 as long as they're earning more than $450 per month. And what it actually is that your employer will have to make a 9.5% contribution of your income on top of your income into a superannuation fund. And what that fund actually does is they invest that money. They invest it so that when you retire at a later stage in your life, you'll have seen that money that's been invested has not only stayed there but grown in value, and so you'll use that for your retirement. And the main sort of way that it impacts businesses is through this whole idea of investing. They take the superannuation that's paid by employers and they invest it, and that's really beneficial to businesses. So the main way that superannuation funds impact on financial management of other businesses is that they invest money into other businesses. So for example, they buy shares. Very frequently they buy shares, or they sell debt securities. So they will loan out money to other businesses in order to make some sort of interest, which is the superannuation fund's return. So in 2016, there was an estimated $2 trillion in superannuation funds. And that is all this potential money that can go into a range of different businesses. So for example, say we are company A in this example. They currently want to raise $100 million in shares. So they put up their shares on the stock exchange, they float their shares. This insurance company, we'll call them insurance company B, they have $50,000 of spare. They've just received all these superannuation contributions today, and they've taken this $50,000 and they're going to buy some of the shares from company A. So what that means is company A gets $50,000 and insurance company B gets the shares. And so during that time, they'll pay dividends, and if they want to sell the shares when they rise in prices, they'll make a return on that. And so if you have insurance company B, you have insurance company C, and you have a whole range of different insurance companies, and they're all investing in company A, that is how they can source some sort of funds. Another impact that superannuation funds have on financial management is that finance management also has to take into account that on top of wages and salaries, they'll also be paying super contributions. So they have to take that into account, especially when they're budgeting, because that is an expense for them. Now, life insurance companies is very interesting, and it's also severely underrated in terms of the syllabus. Usually we associate life insurance with paying some sort of premium on a policy in case you die or you become disabled, and then at the time of that person's death, they get a guaranteed payment. And there's lots of companies that do this, such as Zurich, Real Insurance, Medibank Private. Generally, all your insurance companies tend to offer something around life insurance, and also your superannuation tends to also have life insurance that comes with it. So how does this actually affect financial management? Life insurance companies have sort of the same impact that superannuation funds have on financial managers. Like superannuation funds, they also collect money from their members. In this case, they have people who pay premiums, and what they do is they collect them, they add them all together, and they invest them because they need that money to grow so that when a person accidentally dies or accidentally is injured, they're able to pay out the money that is promised to them in that specific policy that has been signed. So what they do is they take premiums, and life insurance companies actually loan money out. And those loans will have a higher interest than banks. So essentially, the impact that life insurance companies have is they're a source of debt for businesses. They can take out loans by these companies. Unit trusts. This is another really interesting one. It's also known as a mutual fund. So if you see that floating around the internet, especially in the UK, they're the same sort of thing. What units are is they pool together funds from investors, and all that money that gets pulled together is then invested into a range of different sort of assets. And there's 4 different types of unit trusts. You can have a property trust, an equity, so that's like shares in businesses, mortgages, so you can actually invest in loaning people out mortgages and the interest earned you can get back, and also fixed interest trusts. So what investors do is they pool their money together. It's organized by a trustee, so this is the person who controls and manages the trust, and what they do is they invest it. And essentially, those assets and the profits all get divided by people who have invested in this unit trust. And an example is the MLC Master Key Unit Trust over here. You can actually buy shares into unit trusts. They can be sold and traded publicly on the stock market, and you can also have private unit trusts as well. So how do they impact financial management? Well, first of all, businesses can be investors, so they can buy in unit trusts and they can hopefully grow the firm's money. So it's a form of investment where they can see some sort of return. And financial managers will have to advise and figure out which sort of firm they want to deal with when they're buying unit trusts. And so they need to think very critically about that to make sure that they're putting their money somewhere where they know they're going to get a return. And last but not least is the Australian Securities Exchange, all known as the ASX. It's also called the Australian Stock Exchange. Those two are used interchangeably. And we talked about the Australian Stock Exchange when we talked about ordinary shares earlier in the topic. Essentially, the stock market is where buyers and sellers exchange shares and other securities. So businesses can issue new shares by selling on the primary market, and then investors can trade those shares on the secondary market. But how does the Australian Stock Exchange actually impact on financial management? Well, firstly, if you want to actually list your company on the Australian Stock Exchange or float your shares on there, it means that you can raise some sort of equity capital. So you would not be able to sell your shares publicly without the Australian Stock Exchange. It also monitors and enforces regulations for listed companies, and it does that together with another organization known as ASIC, which we're going to learn in the next video. So you have to make sure that you're following by the rules, and the Australian Stock Exchange will look over that, monitor all the different companies, and enforce regulations if rules have been broken. And if you don't want to sell your own shares and raise funds and you want to actually invest surplus funds that you have, businesses can also buy shares on the stock exchange as well. So it's a source of investment, it's a source of raising finance, and it also is closely monitored by the stock exchange to make sure that it's doing the right things.